86.9, the BCI, not very much higher than it was a year ago, so it's gone nowhere fast.
Absolutely. The BCI has always been characterized by something of a ratchet effect. When it takes one giant step forward, it tends to be characterized by two steps back, or one step back rather, shortly thereafter. So it is finding difficulty, it's still finding uncertainty in both the domestic as well as the global markets, but there are certain very promising signs that could point to the April setback being a temporary one. Those promising signs come from the global market firstly, where manufacturing has improved, and that has supported improvements in both exports as well as imports. And we've also seen signs of liquidations coming down. We've seen that the real sector components of the index overall are doing better than they were in recent times. The financial component is not doing all that well. There's still room for improvement, but we do prefer that the real economy components drive a recovery in the BCI initially, only later to be supported by the financial components.
Well, you do mention manufacturing improving globally, and yet there is still a lot of uncertainty out there. So we've had China tightening monetary policy, continuing to tighten in fact, and their PMI heading back down towards that 50 level. Do you think this uncertainty could be a hurdle for the BCI going forward and for confidence in South African business?
Yes, while we were pleased at the recovery in manufacturing, imports and exports in this month's BCI, the previous month was characterized by negative indicators on all three of these components. So we're not certain whether this volatility that we've seen in recent months has been done away with by this month's positive development. We obviously hope that these factors would continue to drive stronger improvements in the BCI and take us towards that significant level of 90. March showed us a stronger promise of approaching 90, being only 2 points away at 88. Now with this month's setback to 86, we're slightly further away. And our optimistic outlook is that we hope to breach the level of 90 by mid-year, all things heading on a more improved path than we're currently experiencing. We've also looked at the BCI in the context of the recently released employment data, and we were quite concerned that there were further job losses in a year when we were expected to be contributing to a fairly strong target of 500,000 jobs. We're starting with the first quarter that offers a setback. So it places greater pressure on the next 3 quarters to contribute to greater job numbers from the private sector point of view. And unfortunately, with this month's BCI, we're not seeing the type of optimism that we need to support that greater contribution to jobs.
Now, what do you think is standing in the way of greater employment and hiring, particularly among your members? Are they hiring? Why are they not hiring if they're not hiring?
Well, business will only hire when it's certain that a fairly decent economic recovery is underway. I don't want to use the word strong because we may be a few steps away from that at this point. But if they're certain that there's a sustainable economic recovery underway, then they will proceed to hire. But they first need to see the benefits of that recovery within their business operations. And right now, the benefits of that recovery are not showing themselves in a sustainable manner within business operations. Only once there's a sustainable evidence that the recovery is underway will businesses proceed to employ, because employment is a longer term commitment. It's not a commitment that they can easily renege on when things go bad again. So business is being very cautious right now. And of course, in the background, the labor disputes that we're seeing, the labor action we're seeing, the proposals regarding the labor relations framework which threaten to make it more rigid, other issues relating to administered prices and the pressures from that front are all causing concern and making business very hesitant and cautious.
So some structural deterrents there as well also to employment.
Absolutely. And while we're seeing positive indications on the global market front from this month's BCI, we still see a substantial caution in terms of domestic markets. We've seen the retail component of our index showing a negative return, the vehicle sales component showing a negative return, and so did construction. So our economy, at least for the month of April, in terms of the BCI, was being driven by its global participation as opposed to its domestic participation. And that's fine. That is an outlook that we've been punting for. But we need to see in the coming months that the benefits of this greater global participation filter down into the domestic economy and drive these other components that reflect domestic activity, vehicle sales, retail sales, and construction, into positive territory. Of course, this is no surprise to you viewers that these factors rendered a negative return. Recent consumer extension data showed that all was not well on that front, and the BCI supports that prognosis.